Well, good afternoon, everybody. There are clear signs that the dynamic has shifted quite markedly in financial markets, certainly in equity markets we're seeing that. And what would give me a bigger belief that the market's going protractedly lower, and that's a move in the S&P through 28, 22, 25. You know, you've seen last few days really clear buying coming into there, big rejections of those levels and on the candles. So clearly, if we do see a reversal now and market trading through those levels, that would give me a greater scope that we've got a bigger pullback on our hands. Certainly, if you have a look at the S&P futures, we saw a nice rally off the 200-day moving average at 27.93. So again, you know, if we can see a close through there and a firm close through there, that would give me a firm belief that we're going lower on these markets. Of course, we'd see implied volatility kick up. We'd probably trade nicely into sort of 25%, and that would see some of the sort of rule-based volatility targeting funds continue to dumping stock. Then you start getting the trend followers involved, the CTAs, and of course, you know, in that situation, you get a more protracted move. And I think we certainly haven't seen a capitulation low in these markets by any means at the moment. But they're the kind of defining moments I'm looking for. And I think the rules have changed, and I think lower bond yields now are being seen as an equity negative. Before, lower bond yields, lower implied volatility gave us a belief that we were happy to pay 18 times forward earnings for this market. The equity risk premium was there. That changed. That dynamic has now changed. We don't have the support from the Fed. Trade wars or trade tensions have become a thing again. You know, I think the Fed are behind the eight ball in this situation. I think the market wants them to be much more like the Reserve Bank of New Zealand or the RBI. But I think the market still has their own situation, their own dynamic, their own path being laid out. They recently saw comments from Jamie Bullard, the St. Louis Fed president, suggesting that he's not watching these day-to-day gyrations and what's happening with trade to set policy, and not much has really changed since their view that we saw in July. But you know, I still think the market is showing a clear propensity to move the Fed funds futures or Euro-dollar futures around whenever we see equity pullbacks. The two things I'm looking at most closely here to cause a much bigger reaction from the Federal Reserve increasing dovishness. One of the financial indices, you know, things like the Goldman Sachs Financial Index or the St. Louis Fed Stress Index. When we saw the 25 basis point cut, the mid-cycle economic adjustment narrative from the Federal Reserve, a lot of these indices were at very accommodative levels. We've seen them start moving up, and we know the Fed placed a lot of emphasis on this feedback loop between financial conditions and economic performance. If we do see financial stress playing through and these indices reflecting that, you know, I think that could cause the Fed to become more dovish at the margin. I think the other thing you need to look at are inflation expectations. 5-year inflation swaps sit at 1.99% at the moment. They're not moving too much lower. They're still trading in that 220, 190 range. If they start gravitating lower as a result of financial stress, you know, that would be another situation that I believe that the Federal Reserve would turn markedly more dovish and try and get ahead of the curve. We're not at that point yet. They're still seeing too much in the way of good data, but you know, obviously the market will create that tension for them. Well, I think there's two dollar markets that we're looking for. Of course, it's the trade-weighted dollar that's got a lot of people talking at the moment. You know, you can have a look at the Fed's trade-weighted dollar and see that's pushing all-time highs at the moment. You know, if we can get a break of 130 on that market, you know, I think that's something that a lot of people will be talking about. It's something that is creating that divergence at a central bank level, at a yield level, and I think that's something that could turn the Fed markedly more dovish on the idea of this dollar flow and what it means for these dollar liabilities, where over 2/3 of full liabilities are priced in dollars. That would become an issue. Of course, the other currency pair we're looking at very closely is what's happening in dollar CNH, and that seems to be driving markets. When dollar CNH is going up, we do tend to see, you know, things like the S&P futures coming off. You know, financial conditions tend to tighten. We tend to see buying in bonds. So that's obviously the other big one we're seeing. But I think as volatility is kicking up at the moment, you are seeing a situation where US yields are outperforming relative to, say, bunds, for example. I know that's a big issue because it's difficult to get much further downside in the likes of bunds at the moment and some of the European debt. And we are seeing that differential close a little bit. But I think ultimately what we need to see is what is happening with volatility. The idea that volatility is rising across all asset classes is seeing an unwind of the carry trade, and that's why euro is outperforming at the moment, and the Swiss franc and the yen. So what you're seeing is an outperformance in this high vol time from these lower, you know, the funding currencies. We're seeing an unwind of carry. So I think you've got to look at the dollar in very, you know, different degrees. If we're seeing high volatility, you're seeing carry unwound. You're also seeing the dollar CNH and the CNY driving the show, but it's also the trade weighted dollar you've got to keep an eye on, because if that breaks 130, there's going to be a lot of cries that the Fed need to be more dovish because of what the stress that's going to cause for some of these dollar liabilities. Gold's a juggernaut at the moment. It's difficult to see what's really going to cause much of a protracted sell-off. I mean, we can have a look at the risk reversal market and look at the skew of call to put volatility on 25 deltas and see that's trading well over 4 at the moment, and that's never been this high. So the market, in terms of where they're positioned in options, I think as a good leading indicator for spot, it has never really been this bullish on where they see price going forward, and that's 1 month or 3 month or whatever time frame you're looking at. Certainly the options market is saying that we're happy to buy up call volatility at the moment. Positioning in gold has obviously become somewhat stretched. You've seen that in the commitment of traders report at the moment. But what's going to cause the reversal? We have to take a view on real yield, of course, and you've got 10-year real yields looking like they may turn negative at any stage. It's about 10 basis points. 5-year real yields are heading that way. We've got a situation where the ballooning pool of negative debt is well over $15 trillion at the moment, and gold's been working well as a hedge against that ballooning pool of negative yielding debt. The fact that gold has no yield is yield in itself in that sort of paradox situation. So gold is being used as a hedge against what's happening in that negative yield. But also, if you look across G10, find that you've got an unwind of the carry, which is causing Swiss and yen upside. But at the moment, gold is working well. Over the last 5 days, gold's up, over 2% against every G10 currency. So gold at the moment is your best currency in a bad neighbourhood situation. So what's going to cause the unwind? Well, you've got to take a look at the bond market. If we do see a sell-off in real and nominal bond yields, then gold's going to cause a bit of a pullback on the idea that there's probably a little bit too much love there in the short term. But that remains a buying opportunity because, I think if yield curves are going anywhere longer term, I think they're going flatter. I think bond yields are going lower, and I think gold therefore has further upside. Well, we've been saying that the 2011 lows around 1522 would probably be a realistic target. We're not a million miles away from that time at the moment. I think longer term, if we were to get a sort of medium term protracted move higher from here, which continues to be our base case over a longer period, 1587 is probably the target we're looking for, going up to 1600, that 1587 representing the 61.8% retracement of the all-time high down to the 2016 low. But certainly in the short term, we're looking more likely where the support levels are. And we don't see too much of a move lower. There is a lot of love in gold at the moment, but I think we're looking at support levels at the moment more appropriately, where we'll be averaging into new long positions as opposed to upside, because I think there's so much love for gold. If we do see a sell-off in yield, then of course gold's going to go a little bit lower. So where is the support going to be kicking in? And that's where we're looking to buy. But longer term, we're still looking for 1522, potentially moving up to 1587 over a more protracted period.